We are already seeing more evidence that tighter monetary policy is reducing price pressures for many goods and services. And with the economy already or soon to be in excess supply, more downward pressure on inflation should be in the pipeline. But our outlook for near-term inflation is higher. Let me explain. The effects of higher interest rates are most evident in the prices for durable goods like furniture and appliances that people often buy on credit. And these effects have also spread to many semi-durables, a category that includes things like clothing and footwear, as well as many services excluding shelter. Inflation in these categories is now running generally at or below 2%. Price increases for groceries, while still elevated at almost 6%, have also eased and are expected to moderate further. Despite this, we've revised up our outlook for inflation. Higher energy prices, structural pressures in our housing market, and stickiness in underlying inflation are all slowing the return to target. Higher global oil prices have driven up gasoline prices, and we now expect oil prices to remain higher than we assumed in July. Inflation in shelter services is running above 6%. Part of this is due to higher mortgage interest costs following increases in our own policy interest rate. But it also reflects higher rents and other housing costs, and these pressures are more related to the structural shortage of housing supply. Finally, near-term inflation expectations and wage growth remain elevated, and corporate pricing behavior is normalizing only slowly. All this is making underlying inflation more persistent. The combined impact of all these factors is that we now expect inflation to be about 3.5% through till about the middle of next year. As excess supply in the economy increases, inflation should ease further in 2024 and reach 2% in 2025. There are both upside and downside risks to this inflation forecast, and the future path for inflation is uncertain. Overall, inflationary risks have increased since July. Today's forecast has inflation on a higher path than we expected. In addition, rising global tensions are increasing risks. In a more hostile world, energy prices could move up sharply, supply chains could become disrupted again, and all of that could push up inflation again around the world. To be confident that our policy rate is high enough to get inflation back to 2%, we need to see more easing in our measures of core inflation. We remain focused on a number of indicators of underlying inflationary pressures, particularly the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior.